Ninja here. I hope you're doing great. I have two stories for you. I don't know what happened on the last live stream, but the internet, it just turned off. And then trucks started driving by. Look, we've got two stories about China reducing the amount of treasuries they're buying, and we have a story about floating rates and how they are damaging not only commercial real estate, but other real estate investors as well in the residential market. It's a very big deal. But hey, what good is a good old-fashioned real estate crash and market crash if you can't take advantage of it? So I'm trying something new. That right there, don't scan it. It's the Black Friday special. I bundled 3 courses: the How to Prepare for the Real Estate Crash course, Home Seller Pro, and Real Estate Media Master. Put them all together for $289. They've never been that low together. Matter of fact, I don't think I've ever marketed them ever together. So if you guys want to take a look at that, that's going to be going on all week long. All right. China, first story. This is out of Crypto Globe. Slashes U.S. Treasury holdings by $518 billion. Moody's lowers U.S. credit score outlook. Now, we already know that they lowered the credit outlook. That's the precursor to Moody's saying, hey, we're going to drop your rates. They have not the rates, but we're going to drop your credit score, right? This is the precursor to that. We already know that everyone else is dropping the rates, so might as or the out. Ninja, get it together. Think, Ninja. I'm so excited about the QR code. It's. I wonder if it works. I don't even know. What are you looking at? Moody's has downgraded the outlook for the U.S. government's credit rating. And why shouldn't it? They are printing money like drunken sailors. They are talking like drunken sailors, especially El Presidente in Chief, in reference to what he said about El Dictador, the Chinese president. It is getting nutty. So it would make sense that China doesn't want anything to do with us. They don't like our economy. They want to crush us. And it's so crazy. The media portrays, you know, China as how bad they are. But then ironically, it's the only thing that could ever get San Francisco to clean up its act for like 3 days, kick all the homeless out of the city, clean up all the poop, and make it all pretty, is when the president meets with the Chinese president in San Francisco. So you got to see all this stuff behind the scenes and how crazy this is getting. Oh, by the way, to everyone that owns the Real Estate Crash Course, there is a bonus video coming out. It's at the editor right now, and it's very timely. So I will send everyone an email. So opt into the emails on Teachable, but there's a bonus lesson coming out, okay? So here we go. China slashing its U.S. treasuries. Over the past decade, China, the world's second largest economy, has been methodically reducing its holdings of U.S. government-backed securities. This strategic move has resulted in China's holdings of U.S. treasuries dropping to a level not seen in over 14 years, according to the latest data from the U.S. Treasury Department. U.S. treasuries are debt securities issued by the U.S. government. They are considered one of the safest investments in the world due to the credit worthiness. Wait a minute. We're going to get to that in a second. That's not looking too good these days. Treasuries come in various forms, including treasury bills, short-term, and treasury notes, medium-term, and then last but not least, gosh, turn down the Ninja. What is with you today? Get it together. Treasury bonds, which are long-term. These instruments are used by the U.S. government to finance its debt and fund various federal activities. Now, you know that recently, the third quarter of this year, the government printed or just made debt of $1.1 trillion. That's absolutely insane in 3 months. This number that they went and raised was surprising even to Wall Street, but it shouldn't be surprising that we're funding Ukraine to hide things that the government wants hidden. Did I say that? Is that going to get me in trouble? Foreign governments buy U.S. treasuries for several reasons. First, for a safe haven, a safe investment. Reserve currency status. Okay, so wait, safe investment, that's becoming not true. Reserve currency, we're losing that. Oh, number 3, liquidity. How liquid are these? Well, it's funny because the government just had to print a bunch of money in the form of debt to pay back the debt it owed. So is it about to be illiquid? When I mean about to be, I'm talking about in the next couple of years. Yield and return. How do you like those? Let me ask you this. Are the yields or the returns on these treasuries, these investments, keeping up with inflation? No, they're not. Now, the government would lie to you. I mean, tell you the truth. I mean, deceive you. I don't know what even the word to say. And they would say, okay, it's you know, the real rate of inflation's really here, and we're offering you this, but we all know that that's not true. And if you think that we understand that, then China gets it. Then diversification. Who cares about that when you're diversifying into total crap? So the point being is that, oh, and trade balances, but that's thrown out the window too, because Russia and China, India, Brazil, South Africa, about a quarter more of the world, their trade imbalances, they don't only care about themselves now because the BRICS nations have completely split off. So it's a big deal. China, it says here, according to an article for the Daily Hodl, China's accumulation of U.S. Treasuries peaked in May of 2013, reaching an all-time high of 1.297 trillion. This period marked the zenith of China's investment in U.S. government debt, and that makes sense because I started hearing about this plan to put the BRICS nations together around 2013, 2015, around there, between those 2 years. And so it would make sense that they would start peaking at that point and then come up with this plan slowly but surely to slowly get out of these debts, so that as not to rock the market and destroy the value of their own investment, and then take over. And that's what is happening right now. Now, another story I wanted to share with you is out of Reuters, and it's entitled "Rapidly Raising Rates Complicate Existing Floating Rate Loans." It says November is out of, this just came out this morning. The rapid rise in interest rates over the past year has had a dramatic impact on commercial real estate lending activity. The rate increases have slowed both fixed and floating rate originations through perhaps not equally, or sorry, though perhaps. I always get those two screwed up, though and through, whatever. Many borrowers who did not need to transact, such as those with fixed interest rates and without a looming loan maturity date, are choosing to ride out the current interest rate environment, hoping that things will improve. I do not believe things are going to improve. I know it sounds crazy. I just did a video this morning where I believe that you're going to see a little bit of dip in rates in 24, and it's a head fake. And I put this video out that's going out to everybody hopefully tomorrow night on the Real Estate Crash Course. It puts it in much more depth, because it's very important that people understand this, because this head fake that the Fed's going to probably, I have a feeling, pull next year is going to confuse and screw a lot of real estate investors. It says a significant portion of real estate loans, however, accrue interest on a floating rate. Debt service payments on floating rate loans rise and fall with a particular index, such as the secured overnight rate. A crucial component of making these loans work from an underwriting perspective is an interest rate protection agreement, often referred to as an interest rate cap. What they're saying is there's a bunch of these different loans out there that affect different entities in different ways. And first off, there's a lot of adjustable rate mortgages being taken out right now in the mortgage market, in the actual residential mortgage market. There's a lot of these rates that float. You have different varying rates between bank to banks. The overnight lending rate, that changes all the time depending on how scared they are of each other. But really the Federal Reserve has taken up the slack on that one through the Fed repo window. And then you have these rates that are floating constantly that have a rate cap, but still inside of that, if the margins are off, it could cause catastrophic changes or loss. The interest rate cap, it says, or agreement, can be thought of as an insurance policy against rising rates. Borrowers can purchase the cap at a loan origination or some later date upon the occurrence of a specified event, such as a relative index rising above a predetermined threshold. Upon a purchase of the cap, the borrower makes a one-time payment to the counterparty in the rate cap transaction. If the index rises above the agreed threshold, called a strike rate or strike price, the counterparty must make payments to the existing the counterparty must make payments to the extent the index is above the strike rate, effectively capping the interest rate for the borrower. The primary economic components of an interest rate cap are the notional amount, the size of the cap, which is typically the loan amount, the strike rate, and the term of the cap, which is often but not always, I don't even know how to pronounce that darn word. Stop this right now. This is the point. The reason why these news stories are coming out about the caps in interest rates is because a lot of companies borrowed money not thinking that rates were going to go up this high. There's a lot of problems in the commercial mortgage-backed arena. It's affecting REITs, real estate investment trusts, and it is going a lot further than most people thought. And so people are starting to come out, the press starting to come out with these explanations and they're trying to explain away the problem. The facts are rates have gotten out of control. The Fed is about to try and push a little bit of stimulus. And when I mean stimulus, all they're going to do is they're going to pause a little bit more than we thought, and they're going to drop rates 1 or 2 quarters, I have a feeling, next year, so that you think that the economy is prospering. It's going to cause the stock market to boom for a short period of time, and you're going to vote a certain way. And then all of a sudden there's going to be an about face, and it's going to be sharp. And this has happened actually a lot over the last, well, since 1974. So everyone that has the real estate crash course, keep an eye out for that video. I'll be uploading it hopefully as soon as the editor is done tomorrow morning. We'll get it right out to you, and it explains exactly what I'm talking about. Sorry, this live stream went to crap real quick. Type 1 if you agree. All right, with that being said, the Economic Ninja, no! See, this is the Real Estate Ninja is out.